I do believe that there's a much higher risk to a resurgence of inflation here over the next year and a half. And because of the liquidity that we're seeing poured into the market, regardless of what's going on in the labor market, I think there's going to be more inflation. That's just what I'm expecting, because especially asset inflation. If you want to protect yourself against inflation, shorter term, probably gold. Longer term, I would say Bitcoin. But
James Lavish opens the discussion by addressing the market's constant anticipation of how the Federal Reserve will adjust its monetary policy. Will the Fed continue with aggressive rate cuts, or will it remain more conservative, cutting by only 50 to 75 basis points by the end of the year? While some market participants are hopeful for more significant cuts, Lavish is skeptical, doubting that a 100 basis point reduction is on the table. He references Fed Chairman Jerome Powell's recent remarks, suggesting that the battle against inflation is nearly over, pointing to a 2.2% inflation number based on the PCE index. Lavish clarifies that Powell's focus on this number might be misleading, as the core PCE, which typically receives more attention, sits at 2.7%. Powell's choice to highlight the lower figure could reflect the Fed's growing concern about rising unemployment. According to Lavish, this shift in focus from inflation to employment signals a broader worry, the possibility of a surge in unemployment that could lead to recessionary pressures.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
the market's trying to decide, is it going to reward higher, like more cuts from the Fed? Is it looking for more cuts from the Fed, saying bad economic data means more cuts from the Fed faster? So another 50 basis point cut, and then maybe a total of 75 basis points, or even another 100 basis points before we get through the end of this year. I don't think so. I think 75 basis points would be a lot, but that's number one. We've heard from Powell a couple of weeks ago that the fight on inflation is all but done. He pointed to a 2.2% number, inflation number, which is the PCE number. That's not the core PCE number. The core PCE number is 2.7%. So he kind of brushed that off and focused in on the number he doesn't usually focus in on. He focuses in on the PCE core number typically, but he kind of said, it's 2.2%. Why did they do that? Because they're concerned about unemployment. To Mike's point, and to what Juan was saying this morning in the morning meeting, apparently, is that the risk is that we have a spike in unemployment. Okay, agreed. So now everybody's looking at listen to what the Fed says and watching unemployment. And so at that 100,000 foot level, what are we talking about? We're talking about, is the market going to be rewarded for negative information still? Or is it going to now tip over to the other side where it says, this jobs report is so bad that we're going to slip into a recession. The Fed's not going to be able to stop it. The Fed's not going to be able to help it unless they pour liquidity in. And that means that we're going to have pain before they do step in. The market is going to have to draw down by 10 or 15 or even more percent before the Fed and the Treasury will step in and start, adding liquidity into the markets, because then it will impact credit markets. And, that's really what we're looking at, is we're teetering on the edge between, that perverse bad news is good news or bad news is bad news scenario. The long bond ownership to me would be a trade only, because if you're looking at this and you think about the terminal rate coming to 3%, well, long bonds are going to be higher than that, much higher than that. So how much money are you going to make between now and then? And then you've got to kind of cut you got to cut loose, in my opinion, because you're going to have higher rates longer, because I do believe that there's a much higher risk to a resurgence of inflation here over the next year and a half. And because of the liquidity that we're seeing poured into the market, regardless of what's going on in the labor market, I think there's going to be more inflation. That's just what I'm expecting, because especially asset inflation. If you want to protect yourself against inflation, shorter term, probably gold. Longer term, I would say Bitcoin. But that's, that's the personal and portfolio decision, portfolio allocation. But I agree, Mike, and we're getting into a period. And even then, if you look at gold in Weimar period, I mean, look at how volatile it was. I mean, you've got that chart, right, Scott? The volatility of gold in the Weimar period. I mean, like, it was massively volatile. It's just normal in periods of uncertainty, especially in periods of uncertainty of a hyperinflation event. I don't think we're going to hyperinflation in the US dollar anytime soon. That's my personal opinion. I just don't think it's going to happen. It's the global reserve currency. There's way too much confidence in it across the entire world. There's no way we're going to go into hyperinflation in the next couple of years. It just doesn't make sense to me. If you look at it, the last 3 month, the last 12 months it's about a 5% expansion, 5.1% expansion of the global liquidity. Although if you look at the 3 month annualized, the last 3 month annualized, it's over 11%. So the point is that, and to Dave's point, this is why these guys are rock stars. This is why everybody's paying attention to central bankers. This is why they're listening to the bankers. They're trying to figure out where liquidity is and where it's going, because this is what's most important to markets. And the reason for that is that we are so financialized, so leveraged across the entire world that this matters more than anything else. How much liquidity is in the system? Is it being added or is it being taken out? Because we cannot keep growing unless we add more debt. That's just reality right now. And so that's why these guys are focusing in on it. Another thing, we were talking about before is trying to figure out where the Fed is going, which is part of this, is how much are they going to cut rates? Well, if you look back at the Fed dot plot, and Mike can pull this up on his Bloomberg terminal. If you look back last meeting, the cuts were being estimated by the Fed officials to, and I'll stop sharing this, but they're estimated to go down under 3%. But now that terminal rate looks like it's going to be 3%, which means that the Fed officials believe that terminal or that neutral rate is around 3%, and we're going to try to get there as fast as possible. And so that's what I expect. I expect us to try to get there this next month. That's just or this next year. That's reality. We're going to try to get to 3% next year. And so, and if we're going to cut more than that, then we have a bigger problem. And then the reality is the other tool will come into play, and that's your liquidity tool, and that's your QE versus QT. We're still technically doing QT. The Fed is still taking $25 billion of liquidity out of the market monthly by letting treasuries and mortgage backs roll off their books. But the reality is that, that's not a lot of QT. They'll switch to QE this next year.
He emphasizes that the world is now so financially leveraged that the addition or withdrawal of liquidity can make or break the market. The Fed is still technically engaging in quantitative tightening QT, removing $25 billion from the market each month. However, Lavish believes that the Fed may soon have no choice but to reverse course and resume quantitative easing, QE, to prevent a significant downturn. This pivot, he argues, will be necessary as the economy faces mounting debt and slowing growth.
Back in the 70s, our debt to GDP was 30%. It's now over 120. Like the difference is that whether or not we've even learned our lesson, it doesn't matter whether we've learned our lesson or not. We're backed into a corner of liquidity needs. Like, we just have to have it, or else you'll have, like, just think about us going into recession. Just think about the numbers of going into recession. We're already at a $2 trillion deficit. Okay. This is what would keep me up at night if I was yelling, is that, oh my God, we're gonna go into a recession. That's a typical recession will make your, let's just call it your expenses, your mandatory expenses and your unemployment, all that, it's going to rise 10%, and then your tax receipts are going to drop 10%. So that maybe 20%, on each side, 10% on each side. So you're talking about, you're going to rise to $3-4 trillion deficits. And if we have a terrible recession like the Great Financial Crisis, you're up over $5 trillion deficit. That would be catastrophic, and they can't have that. So they're going to try to avoid that at all costs.
That's
just
right.
Imagine adding $5 trillion to the debt load in 1 year. You know, it's
Right.
all
But
adding too. Bitcoin is super liquid with hedge funds, and they use it as a risk asset to move in and out of, risk plays. And so we're watching overnight. Japan had been dropping before I went to bed, and so it ends up that you've got the Nikkei down 4.8%. And so remember back when in August 5th, like Mike was saying, Bitcoin got hammered that day that we had the carry trade kind of implode on us, right?
58 to 48 in 1 day.
Right. So, and now look at it today.
it's a good
Now
call.
look at it today. Risk off.
Yeah.
Exactly, Mike. Risk off. So now look at it today. It's actually holding in there very nicely, which is, to your point, Scott, that's an indication along the lines of what you're talking about with the higher lows, and so that the issue with Bitcoin is, are we going to have something that takes over the edge here, in structurally in the market? So you do have a lot of things going on. We're watching what we hear from 8 Fed governors this week, right? Like, we can't get enough of it. That's one thing. Another thing, you've got unemployment reports. You've got your jobs reports on Thursday and Friday. You've got your unemployment number that comes in Friday. And the non-farm payroll is going to be super important because of what Mike just said and what Anna is keying in on. Are we going to accelerate into a 5% unemployment rate, or is the government going to overwhelm this and just keep pouring money into infrastructure plays that are not quite as productive, and creating jobs that aren't quite as productive? Or are we going to have that non-farm payroll kind of hold out here? Is it going to hold in before we
Just
get
going to
this
revise
spike?
it anyways.
They're gonna
They revised jobs down over 800,000. Now we have GDP revised up from 5.1 to 5.5, which is wonderful. That's good news, adjusted for inflation. But like, at this point, we watch these job numbers and it's almost comical. They never are.
Which is interesting, because we're going to hear from all 8 Fed governors or Fed officials, this week, and I would bet that the vast majority of them are talking about employment as the biggest indicator they're looking at. That's reality.
Lavish warns that the U.S. economy is at risk of sliding into a recession, which would have severe consequences for the federal budget. Currently, the U.S. is running a $2 trillion deficit, and a typical recession would only exacerbate this figure. Lavish projects that in a recession, rising unemployment and reduced tax revenues could push the deficit to $3 or even $4 trillion. In a worst-case scenario, a severe recession could result in deficits exceeding $5 trillion, a figure that Lavish describes as catastrophic. The debt-to-GDP ratio, which has already surpassed 120%, would only worsen in such a scenario, leaving the U.S. with little room to maneuver. Lavish notes that while the government may attempt to stave off recession through infrastructure spending and other initiatives, these efforts may not be enough to prevent economic pain.
Please like and subscribe my channel.